of course.
Okay. The Federal Reserve wraps up its two-day meeting today, and we are waiting for any hints of an increase in interest rates. Earlier this month, Federal Reserve Chair Janet Yellen emphasized that she expects the central bank to start raising interest rates at some point before year-end. What does this mean for the markets and your money? I want to bring in JMP Securities President Mark Lehmann and Mainstay Capital CEO David Kudla. Good to see you, gentlemen. Thanks so much for joining us.
Morning.
What are you expecting out of the Fed, David?
I think that we'll see more language about the imminent Fed rate hike later this year. Nothing new except for preparing the markets.
When you say later this year, you're expecting an increase in rates in September or December or what?
Most likely 25 basis points in September, December at the latest.
What about
but that's
you?
all we'll see this year.
I'm a little bit of a contrarian. I think it's going to be later. I think the economy's just not that strong. I think you're seeing commodity deflation. I think you're seeing global deflation. I'm a little bit later.
That's
the
where
real
Keith is.
contrarian call is in the September hike, because obviously Fed fund futures, which are a pretty good predictor of what the Fed does, is 10% or less at this point. So you're thinking a
17%.
September hike in the face of bad and slowing economic data. Again, yesterday's consumer confidence number, et cetera. We've had a lot of rate of change slowing. So that's really the question to me. When people say an imminent rate hike, why don't they talk a little bit more about the imminent data dependence of the Fed, and what if the data is bearish?
Well, I think that's important. If we look at the data, if we look at just the U.S. With existing home sales at an 8-year high, we have the jobless claims are running at all-time lows or lows over many decades, lowest in many decades. But if you compare that, or if you contrast that with their concern maybe for the global economy, what's happening in China, what's happening in Greece, global growth, how much they factor that in. If they just look at the U.S., I think it's likely they could go in September and make the case to go on the data in September.
If you cherry pick the data, I mean, we just had a consumer confidence number that went from 100 to 90. We had durable goods down 3% year over year. We have a CapEx cycle that's falling. You know, there's a lot of late cycle stuff that looks good, which is employment. Housing has been a good story within the story. But I wonder, do you think that the Fed's actually going to raise rates and slow down the recovery in housing?
I think
that's the threat.
Yeah, I think that the Fed is conscious of the financial markets and conscious of what a rate hike will mean. And that's probably the reason they would wait until December to raise.
We're going to get the Fed commentary today, and then we're going to get the GDP report tomorrow. Yeah. And the expectations are what? 2.4, 2.6%.
Well, this is the point that David's making. I mean, they're cognizant of the headline political risk of jobs being good, and GDP is going to be a good number. Just because it was a bad number in the prior quarter, and then it's going to be a bad number in the third quarter. So, again, that's my case. Like, do you really see a Federal Reserve with deflation full on, a bad Q3 GDP number, and your one bad jobs report, by the way, that's next week, away from this Fed fading like a flower?
You think next week's jobs report is going to be bad?
Well, the peak in jobs, non-farm payroll gains, was February. I mean, it's something that you can measure. So, again, it's not an opinion, it's a fact.
So what's working now? Okay, putting the idea that maybe we are going to get a Fed increase some point this year, what's working now? Healthcare and biotech is where you've been.
It's actually continuing to work. And you saw a great number out of Gilead this morning. You're seeing the kind of numbers and the kind of profits that they said they would have, and they're beating those expectations. You kind of have the nifty five of the last few weeks with Amazon and soon to be Facebook and Priceline and Netflix. Look at that market cap.
Not Twitter.
And not Twitter. Now, Twitter's a great point.
And Yelp down 20%.
Twitter and Yelp were formerly kind of your first-tier internet names. They're obviously dissipating their growth. Their stocks are going down a lot. Twitter's very interesting. They have the eyes. They just can't monetize it. Somebody's going to be able to figure that out. They have got to get a leader who can figure that out. Facebook has, Google has, Twitter hasn't.
What do you think, David?
I'm with Mark on healthcare and biotech. Still the place to be. Love the blowout earnings from Gilead. If you take the ETF, IBB, 8% of that ETF.
Is Gilead?
Yep. Also, we think that investors need to look beyond the S&P 500. You know, we think that this year is the death of indexers in 2015. We're seeing that. We'll continue to see that. Look abroad to Europe and Japan, hedge for the dollar, alternative space, and the select stocks and sectors within the U.S.
Can either of you guide on energy? Because Maria and I were talking about that earlier, that seems to be the big wild card right now, with oil prices continuing this slide and the environment changing drastically in this country as we're producing so much oil.
Yeah, I think that's going to be a theme that we continue to play out. Last time when oil hit its lows, the stocks did not. This time, with oil going down, the stocks are going to 52-week lows. That's really interesting to me.
You want to buy them?
I don't. I think it's going to be another bad 6 months to a year.
Final word.
Just over a year ago, we were at $108 on oil. We think we're in a new trading range between 40 and 65. But we think the risk is to the downside of that range. So within the energy space, we love the refiners. Marathon, Valero, they're going to continue to have fat profits.
All right, good ideas. Mark Lehmann, David Kudla, thanks so much for being here.
Thanks, Maria.
We'll see you soon, gentlemen. More